Negative leverage used to be a warning sign. In 2026, it's become the default. Across property types, investors want most. The cost of the loan is now higher than the yield the property produces on day one. So that's the topic we'll dive into today. It was actually inspired by a recent article in Globe Street, and happy to share with you the link to the article. Just tap your reply in the comments, and I will send that to you. But before we dive in, for those who may be tuning in for the first time or perhaps meeting me for the first time, my name is Vessi Kapulian. I am a former commercial lender and spent most of my career in risk management and underwriting and working with founder led enterprises on a variety of credit facilities, structured trade, acquisition, financing, working capital, lines of credit. I'm also an investor. So I've learned not only the downside aspect of investing from my lending experience, but also evaluating the opportunities and an upside as an investor. And today, where I spend most of my time is advising founder-led enterprises and their companies or family offices on governance, risk mitigation, due diligence, and strategic initiatives. And so today's topic, as I mentioned, was inspired by an article I recently came across, and the topic was negative leverage. And so let me actually take a step back and explain what that is, as perhaps that concept is new for some of you. So when you buy a building, it hopefully generates income, hopefully you buy a cash flowing property, and then you compare that income to the price, meaning NOI, the income divided by the price of the property, and you get what's known as the cap rate or capitalization rate. And what that represents is your unlevered yield. In other words, if you were to buy this property all cash, what is the return that this investment will generate? Now, when you put a loan on it, if the interest rate on that loan is higher than the cap rate, you are effectively entering into what's known as the negative leverage territory. In other words, you're borrowing money at a higher rate than the asset will actually pay you. And in that case, the debt is not necessarily lifting your return, but it's dragging it, right? It's going to consume even more cash flow to service the debt. And that's not a unique observation per se, or a niche one that applies to a particular market or a particular segment. So according to a June 2026, I repeat, 2026 analysis from CRED IQ reported in that Globe Street article that I mentioned, the average cap rate on $26 billion of newly securitized commercial real estate loans this year is now sitting almost exactly in line with the average mortgage coupon. In multifamily, there were a number of asset classes discussed in the article, but in multifamily, the average cap rate came in at around 5.45%, around a borrowing cost of 5.64%. In industrial, very similarly, it was 6.03% against 6.33% respectively. And manufactured housing showed the widest gap. The report put it plainly: every favored income sector is now borrowing through its cap rate. Now, I want you to think about that for a moment. The sectors that are not in negative leverage are the ones investors are still nervous about. Hospitality, office, retail, those carry higher cap rates because the market is demanding to be paid for the risk, right? Higher cap rate reflects higher risk profile of the investors. So the investors with positive leverage today are the ones in sectors that people generally fear, and the sectors with negative leverage are the ones that most investors tend to flock to. And that's worth pointing out before we go any further, because that is the part that matters when those investment opportunities are coming your way, whether you're a family office evaluating that or a private investor looking to deploy capital. And so if the deal has or starts off right with negative leverage and the deck still shows positive cash flow on day one, that that cash has to come from somewhere other than the property operations. Again, as we've already established, that's a drag on cash flow. And so, where does it come from? Sometimes it comes from existing reserves, assuming those were raised up front, which is really your own capital being handed back to you and called a distribution. And increasingly, it also comes from the loan structure itself. And so, in that same analysis that the article dove into, 56% of newly issued loan balances were full term interest only. Now, that's another important element I want to highlight. Now, interest only is a legitimate structure, legitimate tool, but understand what it does. It maximizes near term cash flow by deferring the principal pay down or payoff. And in a negative leverage deal, it papers over a spread that has not really gone away. The gap is still there. You're not just facing it yet, but you will face it at the time of exit. So is this necessarily reckless? No, not necessarily. And sophisticated buyers accept negative leverage on purpose. Negative leverage deals may be justified, and a lot of them were getting done when rents were growing at 20-30%. So when that opportunity exists, yes, that risk is somewhat mitigated, but we're not in a 20-30% rent growth situation or market environment, at least not today. And frankly, I'm not sure if we'll see another one like that in our lifetime. But when sophisticated buyers accept negative leverage, they're effectively making a bet that rents will grow or that borrowing costs will fall tremendously, and that one or both will turn today's negative spread positive before it matters. And done with discipline, this is a calculated position. And again, it worked beautifully during the post COVID era. But the problem is what happens when an entire market makes the same bet at the same time. When negative leverage becomes normal or acceptable, the future growth assumption stops being a carefully stressed input and starts becoming the thing that makes a deal, even a thin deal, look like it works. So when faced with that scenario, one question to ask, or one simple question to take a step back and reflect on, is the rent growth in this model conservative, or is it doing the job that current cash flow cannot, so the deal can look strong on paper? And then there is a second effect worth naming. Now, according to CRED IQ, in that same article, it made the point that then markets and not investor optimism are now setting the floor on their valuations. And cap rates in multifamily and industrial have very, very little room to compress further unless borrowing costs come down, which means that future valuations and future valuation gains are now tied to interest rate movements that nobody controls. And that is not a cash flow problem, that is a refinance and liquidity problem that we'll face at the time of exit. And again, it tends to show up maybe not necessarily on day one, but at the time of refinance or sale of the property, which is the least convenient time to be having those discussions. So what do you do with all this information? Well, first of all, if um, determine if the deal is in negative leverage on day one. Compare the entry cap rate to the loan rate. It takes 30 seconds to tell you if this is a great deal. And I'll make one side comment. I'm simplifying things a little bit by comparing cap rate to the interest rate. My personal favorite is actually yield on cost, and I've covered this in prior live events as well as in my publications. But the yield on cost captures the all-in cost to acquire a property. So not only the purchase price, but it would capture rehab, any transaction fees, basically all that goes into the purchase. So if you want to be more precise, I would actually look at the yield on cost. But if you want to keep things simple, looking at the cap rate is a good starting point. Now, secondly, if the deck shows positive distributions early in that negative leverage situation, determine where is the money actually coming from. Is it true operational cash flow? Is it being pulled out of reserves? Is it an interest only structure that perhaps provides a temporary relief? And third, determine how much rent growth does this model need to turn the negative leverage into positive, and by when. So how fast can that happen? Again, realistically factoring in the current and near term market conditions. And last but not least, what happens at the end of the interest only period or at the time of refinance if rates do not fall? Who carries that? And what is the cushion that you have to absorb any stress? So let me close here. Negative leverage is not automatically a red flag, although, again, side comment, for me, it's usually a non starter when I look at deals, but that's predicated on my investment thesis, which may be different from yours. And I want to be clear about it. It's a signal that negative leverage is a signal that the margin for error is very slim. And the return that used to live in the current cash flow now lives in a forecast that rents will go up exponentially, or a forecast that interest rates will drop materially. Neither one you control. And your job as a passive investor or capital allocator or the one underwriting a deal is to find out whether the sponsor treated this as a deliberate, stress tested decision or as a way to make the numbers presentable and the deal appealing on paper, but perhaps not as strong in reality. Because again, a deal can be presented as cash flow positive on day one, but still be borrowing that cash flow from a future that really has to cooperate, and a future where everything needs to go right. And this is where what I'll leave you with today. So if you are reviewing a deal right now and you're not sure how to pick apart the numbers or peel through the cash flow and the waterfall, this is exactly the question worth sitting with. I also help investors exactly with those types of reviews and second set of eyes deal analysis. And if any of that resonated, I would be curious to hear your thoughts and maybe your one takeaway from today's live. Speaking of which, I do these pop-up live events every Thursday, sometimes Friday afternoon Pacific, sharing my thoughts on the market, recent events, questions from investors, family principals, capital allocators. So if you'd like to be notified of future ones, hit that subscribe or ring bell button to be notified. Again, I host this on LinkedIn and YouTube. And I recently published my second book, The Busy Professional's Guide to Passive Apartment Investing, which is now officially an Amazon bestseller. And it is available in print, digital, and audio format. Now, the launch pricing expires on August 11th. So I will post the link in the comments below, and you're welcome to snag your copy today before launch pricing expires. I appreciate you for being here today and spending your afternoon with me. and I will see you soon. Wish you a blessed day. Ciao.